Well, let's go ahead and start the Chapter 6 review of homework. I have the computational exercises for Chapter 6 on the screen. The topic of the chapter is redemptions and liquidations. So the redemption is the company buying stock back from a stockholder, and think privately held, closely held corporations. And then liquidations when the company is doing either a partial or a full liquidation. And the key is, how does the stockholder treat that? And then how does the corporation treat that? We'll look at it from both angles. And also keep in mind they have what they call a qualified redemption and a non-qualified redemption. A qualified redemption means you're qualifying for some kind of a tax break, something that qualifies you for lower taxes, versus non-qualified where you're not going to get the qualification. And this first question deals with that right away, so you have a good handle on what that means. So for question 25, you have Gnatcatcher. You have E&P of $1 million. They have distributed $200,000 to Brandy and UN in redemption of some of their Gnatcatcher stock. The two shareholders acquired their shares 5 years ago. Each shareholder is in the 32% tax bracket. Each has a $45,000 basis in the redeemed stock. Assume, for Part A, assume that the distribution to Brandy is a qualifying redemption and determine Brandy's tax liability on the distribution. So for A, we have it's qualified, and if it's qualified, how you treat that is you look at the distribution. So it's $200,000 per person. So Brandy receives $200,000, and because it is a qualifying redemption, what you do is you subtract the basis of $45,000. So what we'll do is for Brandy, she's receiving $200,000. That's the distribution. We'll subtract the basis, $45,000, and then the net difference between the two is $155. So she'll pay tax at the $155. Remember that with capital gains and dividends, we pay either three different rates: 0, 15, or 20. Those are the three rates we would pay. Only the very top wage earners pay 20%. You have to be in that 37% tax bracket. For a single person, it's like $430-some thousand. For married, filing jointly, it's $460-some thousand to be in the 20% bracket. Under the 0% bracket, you have to, on your personal tax return, I think it's for a single, it's like in the 30-somethings, your income, and then for married filing jointly, it's like in the low 70s. So the vast majority of wage earners in the country will be at that 15%. So they mentioned that Brandy, and both of them, is at the 32% tax bracket. So the 32% tax bracket on the individual side would equate to the 15% bracket for capital gains and dividends. So this 155 is considered to be a long-term capital gain, and Brandy will pay a 15% tax rate on that. So basically it's 155 times 15%, and the amount paid is $23,250. That's what Brandy pays. So we go back to UN, and it says that UN is a non-qualified redemption, determine the liability on the distribution. So for UN, it's a $200,000 dividend. So, and that's basically non-qualified. If it's qualified, we reduce base it and treat it like a long-term capital gain. If it's non-qualified, we treat it like a dividend, and there's no return, there's no basis deduction. So UN is still in that 15% tax bracket. So we'll just take the 200,000 times 0.15, if I can type that correctly, and we just do the multiplication, and we get the tax bill of $30,000. Okay, so that's the answer for 25. A was here, and B was right here. Question 26, Rosalie owns 50% of the outstanding stock of Salmon. In a qualifying stock redemption, Salmon distributes $80,000 to Rosalie in exchange for 1/2 of her shares, which have a basis of $100,000. Compute Rosalie's recognized loss, if any, on the redemption. Okay, so Rosalie owns 50% of Salmon, qualifying stock redemption, so that's important. Qualifying means it's long-term capital gain, we deduct basis. Salmon distributes $80,000 to Rosalie in exchange for 1/2 of her shares with a basis of $100,000. Okay, so it's safe to say that that is a loss, and the reason it's a loss, so remember the basis is 100, but the distribution is 80, so it's a loss of $20,000. Okay, so it's a $20,000 loss. Let me tell you why it's a $20,000 loss. And also, keep in mind that a qualifying stock exchange is treated as, let me say that again, a qualifying stock redemption is treated as a sale or exchange. And because she does not own more than 50%, that's the key here. She owns 50% exactly. She does not own more than 50%, so she can take the loss. Okay, so this loss is recognizable. If she owned more than 50%, so she was at 51% or more, she would not be able to take the loss. Okay, so for Rosalie, $20,000 loss, and yes, it can be taken. Okay, so the $20,000 loss can be taken because it is a qualifying distribution and she does not own more than 50%. Okay, for 27, Dirk owns 250 shares of stock in Rose. Rose Corp. The remaining 750 shares of Rose are owned as follows: 150 by Dirk's daughter, 200 by an aunt, and 400 by a partnership in which Dirk is at 80% interest. How many shares does he own directly and indirectly in Rose Corporation? So the chapter talks about what they call attribution. And attribution, the way to think about it is think of your direct line descendants. Okay, so the chapter talks about parents, children, grandchildren. Direct line. So an aunt is not a direct line. So think the trunk of a tree, not the branches. Okay. So the direct line, that counts as attribution for ownership, but the branches like an aunt or a brother or somebody like that would not count. So for sure, when we look at this, we know that Dirk owns 250, and we know that Dirk's daughter owns 150. So the 250 plus the 150 is, yes, that falls within the attribution. And then we look at the partnership. Dirk owns 80% of it, and the partnership owns 400 shares. So you can kind of do the mental math on that and go 400 times 0.8 is 320. So the way this works is then we know that Dirk has the direct ownership of 250. We type in the right number. The daughter owns 150. And then we know that the partnership owns 400 shares, and Dirk is an 80% owner. So 400 shares times 0.8 is 320. We sum those up, and we get 720 shares. So basically, we're saying that Dirk owns 720 shares. For question 28, it says here that Indigo Corp wants to transfer cash of 150 or property worth 150 to one of its shareholders, Linda, in a redemption transaction that will be treated as a qualifying stock redemption. So that's the key there. Qualifying stock redemption. So that means we treat it like capital gain or loss, and we subtract the basis. If Indigo distributes property, the corporation will choose between two assets that are each worth 150 and are no longer needed in the business. Property A, the basis is 75, so fair market value 150, basis of 75, and then property B, fair market value of 150, but the basis is 195. So the property is what I'll call upside down. By upside down, meaning the fair market value is lower than the basis. So for part A, indicate the gain or loss by Indigo. So this is the corporation if it distributes property A in redemption of Linda's shares. So for part A, it's pretty simple. It's a $75,000 gain. The 150 fair market value minus the basis 75. So the answer for A is a $75,000 gain. For part B, what is Indigo's recognized gain or loss if it distributes property B in redemption of the shares? Okay, so that property, remember, is upside down, worth 150, basis of 195. So there'd be a $45,000 loss. Now the key is that's a disallowed loss. So if the corporation did this and they distributed that property B to Linda, there'd be a $45,000 loss, but it would be disallowed. They would not be allowed to deduct that for tax purposes. And at 21%, that'd mean they're missing out on roughly a $9,000 tax break. So they don't want to do that. And that's very similar to what we did for Chapter 5. We talked about distributions as dividends, and it's kind of the same story. So if I'm doing this qualified redemption here, if Indigo was to do property B, I mean, they could do it, but it wouldn't make any sense because they don't get a tax break. So if you recall from the previous chapter, what you should do then as Indigo would be to sell the property to an outside third party, an independent party, collect 150 from that person, from that party. You'd realize the loss of 45, and that you would get the tax break for that. Then turn around and take the cash from selling the property, and then distribute that to Linda, and then you're okay. For part C, it says compute Indigo's recognized gain or loss if it sells property B, which is, I basically just answered that one, to an unrelated property. So that's what they should do. They'd realize the loss, give the cash to Linda, and all is good. That would be the best for them to do in terms of saving on tax. Question 29, excuse me. Carmel Corp has 5,000 shares of stock outstanding in a qualifying, keyword there is qualifying, stock redemption. They distribute 145 in exchange for 1,000 shares. At the time of the redemption, Carmel is paid in capital of 800,000, 300,000 of E&P. Calculate the reduction in their E&P as a result of the distribution. So the key is that they basically they had 5,000 shares. They redeem 1,000 shares. So 1,000 divided by 5,000 is the key here. So 1,000, then 5,000. So that's 20%. If you take those two numbers, that'd be 20%. And I multiply that by the E&P. The E&P is 300,000. Okay. And remember that from this perspective, we're looking at Carmel Corp. We're looking at how this reduces their E&P. So this is the corporate side. We don't know anything about the individual who received the redemption. We don't know anything about that person. So I'm taking the existing E&P, and I'm reducing that by 300,000 multiplied by 1,000 divided by 5,000, which is 20%. So you just take that divided by that, 20%. Then I take the 300,000 times 20%, and I get 60,000. So that's one answer. And then remember that the other number they mentioned to us, and they gave us the paid in capital of 800,000. We didn't need that number. That's just a number they gave us to kind of throw us off the track. They distributed $145,000. So cash was paid of $145,000. And the answer is, how much should E&P be reduced by? And the answer is the lower of the cash paid or the reduction to E&P. So 60,000 is the answer. That's the number I'm going to use. So the answer is the lower of the cash distributed, 145, or the reduction to the E&P, which is 60. And the 60,000 is lower than 145. So that is my winning number. Okay, question 30. Sunset Corporation with E&P of 400,000 makes a distribution of 120 to a shareholder. The shareholder's basis in the stock is 50. Determine the tax consequences to the shareholder if the distribution is non-qualified. Non-qualified. So if it's non-qualified, it's a dividend. You just think of it as a dividend. That's all it is. So the shareholder receives a $120,000 dividend, and that's the answer. Very simple. For part B, what's the tax consequence to the shareholder if it is a qualifying distribution? Well, if it's qualifying, that means I qualify for a better tax deal. That means I would take the 120 minus the basis of 50 and have a $70,000 long-term capital gain. Okay, so in part A, I paid tax on 120,000. On part B, I paid tax on 70,000. For part C, it says determine the tax consequence of the shareholder if the distribution is pursuant to a complete liquidation of Sunset. So now we're looking at complete liquidation. It's still a capital gain. So even though C is a complete liquidation, we treat it the same as B. It's still a long-term capital gain, 120 minus 50 for 70. So they both work out the same way. For question 31, it says here, pursuant to a complete liquidation, Carrot Corp distributes its shareholders real estate held as an investment, basis of 650, fair market value of 880. So kind of keep that in mind there. Fair market value is higher than basis. 880 minus 650 is 230. Determine the gain or loss recognized by Carrot on the distribution if no liability is involved. And that's very straightforward. It's $230,000 gain, right? Market value minus basis is 230. So the answer to A is 230. For B, determine the gain or loss recognized by caret if the real estate is subject to a liability of $690. So in this example, the liability is below fair market value, and that's the key. So we're going to treat B the same as A because liability is lower than fair market value. Okay, and as long as that's the situation, I'm okay, and I can treat this as a $230,000 gain. Okay. For part C, we're going to flip that around now. So now we're going to say, what's the gain or loss on the distribution if the real estate is subject to a liability of $885? So here, what I want you to recognize is the liability is greater than the fair market value. So liability is more than fair market value by $880. So I'm going to show you how this one works. With this one, it's pretty straightforward. I take the $885 liability, I subtract the basis, and that difference, if I just add those two up, is $235, and that's my capital gain. Okay. So liability minus basis is capital gain. So the capital gain is $235. So I go back to 31 part C, capital gain is $235. So for A and B it was $230, $880 minus $650. For C it was $235, $885 minus $650. Okay, so that's the key with that one. So when you have a question like that in your homework, the question to ask yourself, is the liability greater or lower than fair market value? Question 32 is Osprey Corporation. They have stock owned by two people, Pedro and Pietro, who are unrelated. Pedro and Pietro each own 50% exactly of the stock in the corp. Osprey is the following assets, none of which were acquired in the 351 contribution to capital transaction and distributed in complete liquidation of the corporation. So cash is cash, nothing's different there. Land, though, look at the land, has a basis of 200, fair market value of 440. The equipment's the other direction, basis of 250, fair market value of 140. It says here, assume that Osprey distributes the land to Pedro and the cash and equipment to Pietro. So for part A, determine Osprey's recognized gain or loss on the distribution of land. So this is question 32, part A. And with this one, it's really simple. It's a gain of 240. Okay, it's a liquidating distribution. That's the key. And basically the answer is liquidating distributions generally result in a gain or loss is that the property was sold at its fair market value. Okay, so that's very simple. How about for B? Was Osprey the corporation's gain or loss on the distribution of equipment? So it's obviously $110,000 loss. 250 minus 140 would be a loss of 110. And Osprey would recognize a loss of 110 on the distribution to Pietro. Again, liquidating distributions generally result in recognized gain or loss as if the property were sold for its fair market value. Okay. Now, the related party loss limitation does not apply because the distribution is not more than 50% shareholder. Okay, so Pietro owns exactly 50%. If he owned more than 50%, it'd be a different story. It'd be a disallowed loss, but because it's exactly 50%, the loss is allowed. Okay, I'm skipping 33, so we'll go down to 34. It says here that Green Corporation's assets are valued at $920 after payment of all corporate debts, except for $134 of taxes payable on net gains get recognized on liquidation. Bruno, an individual and the shareholder of Green, has a basis of $280 in the stock. Compute the gain or loss recognized by Bruno on the liquidation of Green Corporation. Okay. This is very straightforward. So basically we just have the market value of $920. And then we have the tax bill liability of $134. Then we subtract the basis of $280. So it's very straightforward. It's as easy as you might think it would be. There's no tricks with this one, which is kind of nice. So it's just simply the $920 minus $134 minus $280. Okay, the sum of those three numbers is $506. and that is the recognized gain for Bruno. And Bruno is the stockholder. Okay, so 506. Question 35 says that the stock of Quail Corp is owned as follows: 85% by Pheasant, which is a corp, and 15% by Gisela, which is an individual person. Quail Corp is liquidated in December of the current year pursuant to a plan adopted earlier in the year. At the time of liquidation, Quail Corp has assets with a basis of $730, fair market value of $1 million. Quail Corp distributes the property pro rata to Pheasant and to Gisela. For Part A, compute Quail's recognized gain or loss in the distribution of property to Pheasant. And this one's very straightforward. There is no gain or loss. And the reason is because this is a parent-subsidiary transaction. Because it's a parent-subsidiary transaction, there is no gain or loss on liquidating distributions to Pheasant, the parent. Okay, so there is nothing. For Part B, what's the gain or loss to Gisela? Clearly not a corporation, so it's outside third party. So clearly not a related party subsidiary. So for Gisela, what we do is we look at the fair market value is $1 million, and then we've got the basis of $730, so obviously the difference would be $270, and Gisela gets 15% of that. So Quail would recognize a 15% gain on that one. So let's go back and I'll show you the numbers here quick. So $1 million fair market value minus the $730 basis. Oops, typed in the wrong number. Okay, so that difference is $270. 15% of that, so I take 270 times 0.15, which is Gisela's ownership percent. So for Quail Corp, Quail recognized a gain of $40,500 on the distribution to Gisela, but there is nothing to recognize on the distribution to Pheasant. Okay, so let's go to question 36. Blush Corporation owns long-term bonds, basis of $1.3 million of its sub, Brass Corp, that were acquired at a discount. Upon liquidation of Brass pursuant to Section 332, Blush receives a distribution of $1.5 million, the face amount of the bonds. Determine Blush Corp's recognized gain or loss on the distribution. Now, at first glance, you might be thinking this is related parties, so there can't be a gain or a loss. And generally that's true unless it's settlement of debt. Okay, so if it's debt, like which a bond is, you can recognize gain or loss on the settlement of debt in a parent-subsidiary relationship. So Blush bought the bonds for $1.3 million, received $1.5 million to liquidate the bonds. They do have a gain, a realized capital gain of $200,000. That is allowed. Okay, so because it's a settlement of debt, that was the key with 36 and how 36 is different than 35. Okay, I'm skipping 37, so let's do one more problem, then we'll be done. It's question 38, and it kind of goes back to the basics of the chapter of what's qualified versus non-qualified. So Teal Corp with E&P of $2 million distributes property with a basis of $150 and a fair market value of $400,000 to Grace. Grace owns 15% of the shares of Teal. So fair market value of 400, basis of 150. So you can kind of do the mental math there and go, that'd be a $250,000 gain. So what are the tax consequences to Teal and to Grace if the distribution is a non-qualified stock redemption? So let's look at Teal first. So Teal would have a taxable gain of $250, the difference between the fair market value and the basis. So for Teal, capital gain of $250, and then that'd be an ordinary capital gain. And then let's think about their E&P. So let me go back to Teal here. Let's just do the E&P calculation for Teal. I'm just going to delete some stuff. Let's do the E&P calc for Teal. So Teal's E&P would go up by $250. So that'd be an increase because of the long-term capital gain. That's an increase. It would also then decrease by the basis. I'm sorry, by the fair market value, not the basis, fair market value. Okay. So the net decrease to E&P, oops, let me get some of the right number here, is minus 150, which is the basis. So that's the net decrease to their E&P, okay, which coincidentally is the basis on the property. Okay, so that's the same. This is for Teal. So this is Teal Corp. And this will be the situation for all the answers. They're going to give us several categories of answers here and do a lot of what ifs. No matter what Teal does with this distribution, this is the net decrease to their E&P, okay, on the distribution. So that will never change. So after that, the questions kind of deal more with Grace and how the situation would be treated to Grace. So Grace, in this example, is an individual, and she receives a non-qualified stock redemption. Just be thinking, this should be pretty straightforward. She receives essentially a dividend of $400,000. Okay, so then she would pay the appropriate, either 0, 15, or 20% tax. It wouldn't be 0 because she's made $400,000 worth of income, right? So she's at $400,000. If that was her only income, she'd pay 15%. But she's really close to over that 430 to 460 range, which is going to put her into the 20% category for paying tax on dividends. So for sure she'll pay 15% tax, possibly 20 on that. But we're going to treat that whole $400,000 just as if it was a dividend. So for Part B, though, the difference is, what if Grace is a corporation? So Grace Co. Okay. Well, if she's a corporation, she's going to qualify for the DRD, the dividends received deduction, right? And we talked about that. I think it was Chapter 3. I forget if it was Chapter 3 or 4. But the dividend received deduction, so she owns less than 20%. In a 20% or lower ownership, she qualifies for a 50% dividend received deduction. So she'll treat as the corporation, so I'm saying she, but the corporation, Grace Co., will receive a dividend $400,000 and then automatically deduct 50% of that, $200,000, as non-taxable. So $200,000, no taxes paid on. The other $200,000, tax would be paid on at the corporate rate of 21%. Okay, so now for Part C, what's the tax consequence to Teal and to Grace if the distribution is a qualifying redemption? So I went to great pains in Part A to say, for Teal, no matter what happens, it's still this number here. So if it's qualifying or not qualifying to Teal, the net decrease to E&P is still 150. Okay, so now let's just kind of think through for C, if Grace is back to being an individual, and it's a qualifying redemption, and her basis is 90. It'd be 400,000 minus 90 to get to 310, and she'd treat it like a long-term capital gain of 310 and pay tax of either 15 or 20. Okay, so she got a better deal with C than she would with A. For Part D, what's the tax consequence in Part C if Grace is a corporation? The same. Nothing's changed there. I'm sorry, got ahead of myself. So if Grace is individual for C, she has a long-term capital gain of 310. For D, it's the same answer. For what's the tax consequence if she's a corporation? Same answer. 310 long-term capital gain and pay the 21% tax rate as a corporation on that. If both parties involved could choose from among the preceding options, what would they choose? So to Teal, it doesn't matter. No matter what the option is, there's a net decrease to E&P of 150. So Teal doesn't care what the deal is. Think about Grace now. So basically, how much do you want to pay tax on? For Part A, Grace would pay tax on $400,000. For Part B, she pays tax on $200,000. For Part C and D, she pays tax on $310,000. So clearly B is the answer. If Grace Co. is a corporation, the DRD, the dividend received deduction, kicks in, and you only pay tax on $200,000. So even if you're paying at 21%, the corporate rate, you're only paying on $200,000. Clearly, that's going to be the best deal. Okay, so the chapter is a little tougher in terms of the slides and some of the examples to read through. But I think the homework is actually really straightforward. So I guess good news, bad news from that perspective. So I don't think you'll struggle with the homework too bad. The chapter does have some really good examples in it. So I would say for sure, just make sure you're reading through your chapter and looking at the examples. So as you do your homework and you feel like you need an example to follow, go back and find that topic in the chapter and look at the example given to you there, and that will help a lot. And the big picture example from this chapter is really good too. So about Orange Company and Christina, the owner, and her desire to transfer the business to her daughters. I think you'll discover that's pretty good information that will help you quite a bit. Okay, if you have questions, just let me know. I'm happy to help. Thanks.